Over the past few weeks, China has experienced its worst outbreak of COVID-19 in 2 years. In response, it has imposed strict lockdowns and travel restrictions. Foreign business leaders say these measures are even tougher than they were in early 2020. In particular, stay-at-home orders and nucleic acid testing requirements have devastated China's economic centers along the coast. Since late March, Shanghai, China's largest city with 25 million people, 3 times the size of New York in population, has been under complete lockdown. China's lockdown is a bigger threat to inflation today than it was in 2020. In an April 8th report, analysts at Bernstein, a private wealth management firm, said that China's lockdown is a greater threat to inflation today than it was in 2020. They said the world has become more dependent on Chinese goods since the pandemic began in 2020, meaning the latest round of lockdowns has had a greater impact on global growth and inflation. They found that China's exports of cars and parts had more than doubled in 2021 compared to a year ago, and overall, Chinese exports grew by more than 30%. In 2021, China's share of global exports rose to 15.4%, the highest level since 2012. China's manufacturing sector accounted for about one-third of global manufacturing. The US got more than 15% of its imports from China. Japan got more than 20% of its imports directly or indirectly from Chinese goods. India, a major drug producer, got 70% of its active pharmaceutical ingredients from China. And in Vietnam, 24% of the total added value of the manufacturing industry came from Chinese components. Chinese exports provided the bulk of overseas demand for containers, ships, rare earths, and solar modules, as well as most cell phones and personal computers. According to the report, Chinese factories no longer only complete the final assembly of these electronic products, but also produce components such as LCD panels and integrated circuits, noting that the exports of these components achieved faster growth in 2021. The report said the cost of exporting containers from Shanghai is 5 times higher and air freight costs are twice as high compared to pre-epidemic levels, noting that suppliers are facing similar pressures on delivery times. As a result, inflationary exports will increase, especially to China's larger trading partners, but at the same time will delay China's own demand recovery. China's trade data for the first quarter showed steady export growth. A Bernstein report said, "We believe that the macro impact of the China lockdown may be significant and that this has not yet been reflected in the prices of financial markets, namely markets haven't priced those in." Data released by the U.S. Department of Labor on April 12th shows the Consumer Price Index, or CPI, rose to 8.5% in March from 7.9% in February, a 40-year high. U.S. prices have been rising and inflation has been above 6% for 6 consecutive months, well above the Fed's average target of 2%. Prices in the Eurozone rose to a record 7.5% in March. Data released on April 11th showed that soaring energy and raw material prices led to faster than expected increases in China's Producer Price Index and Consumer Price Index in March. The lockdown has led to production shutdowns by automakers. Bernstein reported that China, since the beginning of the pandemic, has become a significant manufacturer in the auto industry, especially in the electric vehicle supply chain. Tesla's Shanghai plant has been shut down since March 28th. Based on a production capacity of 2,100 vehicles per day, its production has been reduced by more than 50,000 units. Chinese electric car company NIO announced a production shutdown over the weekend of April 9th and resumed partial production on April 14th due to supply chain disruptions. German automaker Volkswagen said its factories in suburban Shanghai and northern Jilin province remain closed until at least April 21st. Analysts say China's auto and parts exports grew an average of 119% year over year in 2021, outpacing the country's overall export growth rate of 30%. China accounted for 74% of global battery production. In March 2022, its passenger car exports grew 14% year over year. The Bernstein report said Tesla, BMW, and other automakers are now increasing the production of electric vehicles in China for export to other countries. State-owned Chinese automakers SAIC and Chery are the top exporters of Chinese passenger vehicles, including fuel-powered vehicles. Chinese-made vehicles to Chile, Egypt, and Saudi Arabia have also grown as well. Although the report did not discuss the specific impact of the COVID lockdown on the auto-related supply chain, analysts noted that many Korean and Japanese automakers experienced production disruptions in 2020 when COVID forced the Wuhan lockdown. Lockdown in Shanghai exacerbates global supply chain. As of April 15th, Shanghai has been fully closed for more than half a month, with the Pudong district closed for nearly 3 weeks and parts of Minhang closed for nearly 40 days. Shanghai is not only China's economic and financial hub, but also a hub for international aviation, shipping, and logistics. The port of Shanghai is the world's largest container port and was responsible for 20% of China's foreign trade throughput in 2021. Given the importance of Shanghai in the global supply chain, the industry believes that a prolonged closure of the city will have a serious impact on the global supply chain. According to a study by the Spanish bank BBVA, if the port of Shanghai ceases to operate, the global supply chain will directly feel the pain of Shanghai's closure, given its huge capacity and the difficulty for other nearby ports to fill the gap. In addition to Shanghai, Zhejiang and Jiangsu are also manufacturing hubs in the Yangtze River Delta region, accounting for about 1/3 of China's total exports. The Finance Committee of Taiwan's Legislative Yuan confirmed on April 11th that 161 Taiwanese companies in Shanghai and Qinshan City, Jiangsu Province, a major Taiwanese manufacturing town, had announced a work shutdown. According to a survey of 167 U.S. companies conducted by the American Chamber of Commerce in Shanghai, as of April 1st, more than half of the U.S. multinational companies there have lowered their annual revenue forecasts due to the outbreak in Shanghai. More than 80% of manufacturers have reported a lack of staff and raw material supplies, resulting in slower or lower production, and 77% of companies have expressed dissatisfaction with the length of the quarantine period. A spokesman for the International Chamber of Shipping, ICS, said that China is the source of many of the world's trade routes, and any disruption of China's shipping routes would have a global impact. However, supply chain disruptions have a lag effect, and the impact of the China closure is expected to continue to fester in the coming weeks and months. Michael Wax, CEO and co-founder of digital freight forwarder Forto, said the surge in infections in China and the resulting port congestion will have a domino effect on the global supply chain, with the shockwaves expected to reach European markets in 6 weeks. James Hookham, head of the Global Shippers Forum, told Express.co.uk that China's lockdowns have led to massive cancellations, but the lifting of the restrictions in Chinese cities such as Shanghai could lead to a surge in traffic, overwhelming international ports. Doug Barry, a spokesman for the U.S.-China Business Council, said Christmas orders need to be fulfilled before the summer, and port blockages could cause costly delays and possibly even a shortage of goods on shelves for the year-end holidays. Restrictions on truckers aggravate port congestion. In June 2021, the Yantian port in Shenzhen was closed for nearly a month due to the epidemic, causing a backlog of tens of thousands of sea containers and forcing many ships to wait outside the port for weeks, severely impacting the global supply chain. Since the beginning of 2022, Chinese authorities have tried to cushion the impact of the epidemic restrictions by keeping ports and airports operational and encouraging closed-loop production. But, as reported by the Chinese portal website Sohu on April 1st, while the port of Shanghai remains open, transportation to and from the airport and container terminals has been severely restricted due to the sealing off of roads, bridges, and tunnels between its 2 districts of Pudong and Puxi. Relevant data shows that since the beginning of March, the Shanghai port has been congested, and the number of ships waiting for loading and unloading has increased nearly 5 times in the half-month period up to April 1st, affecting more than 14% of the container capacity. The Sohu report predicts that with the large-scale screening of nucleic acid in Shanghai, the congestion in the Shanghai port will only get worse. According to cargo data from overseas media, as of April 11th, 222 bulk carriers were waiting off Shanghai, a 15% increase from a month ago. Refinitiv, an American-British global provider of financial market data, says the number of container ships waiting at the port of Shanghai and a nearby port has more than doubled since the beginning of April and is almost 3 times the number of a year ago. Trucking is an important part of China's supply chain, with road traffic carrying more than 70% of the country's freight. However, truck drivers have been restricted in their movements due to the strict lockdown and inspection measures imposed by the communist government at all levels, making it difficult for many companies to transfer raw materials and finished goods between ports and factories. Land traffic constraints have led to tight port operations, forcing many shipping lines to change their operations. Companies have canceled some of their shipments to Shanghai using other means such as rail. In addition, due to the low efficiency of trucking and the difficulty of entering the port, some yards in the Shanghai port have been under pressure, and companies have been forced to transfer dangerous goods and reefer containers to other ports for discharge. The World Bank president said diversifying the supply chain from China could be good for everyone. World Bank President David Malpass said on April 12th that countries around the world are trying to diversify their supply chains and reduce their dependence on China, and it could be good for everyone. When asked whether China is headed for a crisis because of the severe COVID-19 lockdowns and debt problems in the real estate sector, Malpass said, "They are experiencing setbacks, major setbacks in all areas, and forecasts for growth have been revised downward." Malpass said cross-border trade remains important to the global economy, and China, already the world's second largest economy, has an important role to play as both a consumer and a producer of goods. But, at an event in Warsaw, he said China also needs to be part of a value system shared by other countries in the global trade system, but added, "I don't know that it will happen." He also said he didn't believe the world was facing a new Bretton Woods moment, a reference to the 1944 conference that transformed the international financial architecture and created the World Bank and the International Monetary Fund out of the ashes of World War II. He added that the system, with the US dollar at its core, is working well.